Okay, I think we'll get started. Welcome everyone to Retirement Income Journal's webinar with David Lau of DPL Financial Partners. We're delighted to have David here. He's an entrepreneur and happens to have been probably as much as responsible as much as anyone for bringing together annuities and RIAs. Which a few years ago are two expressions that people didn't really associate with one another. And yet we all knew, we who are in the business, knew that that RIAs as fiduciaries would need to respond to their needs of retirees, and we knew that annuities were essential for retirees who need guarantees for different kinds of risks that people in the accumulation mode do not need. And so it was only a matter of time, really, and yet over the years there have been numerous technical and business model barriers to bring those two groups together, and they are now probably for reasons having to do with APIs and other technology, and because of the work of entrepreneurs like David, we're now talking about these things at the same time on the same morning. So David, welcome, and is that a fair summary of the big picture?
Yeah, I think that's great, Kerry, and thanks for having me. It's always great to talk to you. I'm looking forward to the session. You always have great insights and great questions, which is why your readers get really good content. Yeah, I would just add that, like you said, looking at the RIA market and understanding the need for annuities, for RIAs to have them as tools. I mean, that's been kind of the driving impetus for DPL, along with other types of insurance. But certainly around annuities, I've always said RIAs would be power users of annuities had they always been commission free. I mean, the value of them is compelling. So the issue has always just been they didn't work in their business model. Mm-hmm. So that's what we're trying to solve for, and that's what we're trying to drive the industry to, so that the RIA community can be have access to these powerful tools.
Okay, well, let's just jump in and look at some of these powerful tools. We're going to talk about products for part of the show, and then we're going to talk about how they're used and how they work inside of the practice of a RIA, and then we're going to talk a bit about your platform, which I think is probably the real red meat of the discussion. But let's work through these products. Which of these products would you say that there's the most interest in among RIAs right now?
Ooh, that's a good question. So certainly products that can be fixed income replacements or alternatives within portfolios. Fixed income is really challenging, for RIAs right now in numerous different ways. There's just so little yield in the traditional fixed income investments, bonds and bond funds, et cetera, that it's hard to even justify a fee, on the kind of yields that you're getting out of fixed income right now, and the yields don't keep up with inflation. So when you look at the products that that gets RIAs interested in terms of the insurance, it's really the first three on the list here right now. The fixed annuities, MYGA, which is just a fancy term for multi-year guaranteed annuity, like equivalent to like a 3-year term or a 4-year term, like in a CD. Fixed indexed annuities are probably the most popular product, because they kind of combine that fixed income like accumulation, which can get turned into a guaranteed lifetime income stream. So that's probably the most popular. And then the structured products are just popular in general. And I know we'll talk in some a little more detail on some of the products, but those are the ones that are really most popular and kind of in demand today.
Now, I've been writing about fixed index for a long time, and gradually the independent broker-dealer channel and the RIA channel have taken an interest in them. And these are usually, in the past, complexity has been the a barrier to the use of these products, and they do have quite a few details. And how are the advisors navigating those? Do they know pretty much what they want when they, or are they, deer in the headlights when they see, well, I've got 100, I've got 4 indexes to choose from. I got 7 crediting methods. I can mix and match. I can even hire a service now that'll optimize the indexes for me. How are they dealing with the complexity? Does that doesn't really go away, does it?
I mean, in some ways it does. And so, I mean, I look at, fixed index, and we talk about them, with RIAs in much the same way you talk about a mutual fund, right? A mutual fund is a really complex instrument below the surface, right? But what's the purpose of it? So as an advisor, you should understand how an FIA works, and we help educate, on those kind of things, for the firms we work with. So we can help the advisor have a good understanding of them. But the practical implementation is actually pretty simple, right? So it's got an accumulation phase, and you can invest in a fixed account, or you can invest in an index, which is going to, replicate, some investment strategy. So and then you can, as we see, often on our platform, advisors using it then for the guaranteed income, rider or feature that, might be available. So the actual use of the product is pretty simple. Understanding the mechanics beneath, that's where it can get a little complex, as leveraging the option strategies to deliver the index-like returns. That can be a little complex, but again, most financial instruments are fairly complex beneath the surface.
And do you know whether advisors are looking mainly for the uncapped strategies, because that's always been the magnet, but there's something to be said for participation and spread strategies too. But is it the uncapped that they're going for? Can you tell from your data?
Yeah, it's a little bit of a mixture, really. Because our user base, the true RIA user base is different than a lot of the other advisors who might use FIAs, where they're looking at them as true fixed income replacements. So the FIAs that we offer, the fixed account is typically, I think right now the various, we've got many of these different products. The fixed accounts are 2.5%, 2.75%. So a lot of RIAs look at that as saying, I can not worry about the complexity of the index or worry about the index. I can just invest in the fixed account, and that's better than I can get in the bond right now. So a lot of our users will use the fixed account, at least for half of the allocation, and then they might look at, going for some upside in one of the indices, that might be available, and the participation rates, are seeming to get, become a little more popular. Initially, there's a lot of, comfort with the, cap rates, because they can understand this is, you're going to get a range of returns, whatever between 0 and 6%. But spreads are, spreads, which I should probably explain for people who don't understand some of these things we're talking about. But the difference in the way an index gets credited, there are basically 3 different methods. So one is that you can have a cap, meaning you might have an S&P index that offers a 6% cap, meaning the client is going to earn between 0 and 6% depending on how it performs. Right? So that's the cap. The participation rate will be a percent. We'll say that your client is going to get a percentage of the return. So whether it's 60% of the return or 50% or 80%, whatever it might be, it's not capped, but it's just limited by the percent of the return you're going to get. So that's the second strategy, and then third is the spread, which is kind of more analogous to like a fund cost, right? So you're paying the spread, which might be 1%, and everything above that 1% return is what your client is going to earn. So so we look at that as kind of like a fund cost. I think ultimately that might be the most popular strategy, because that's going to be most analogous to what RIAs think about when they invest otherwise. But right now you don't see a lot of indices available that go to spreads. Most are in par rates or cap rates.
Right, and an actuary told me that you go for this. The spread is most useful if you want to take advantage of a big spike in the index. If you've got a 2% spread and the index goes up 17%, you've got a 15% gain, right?
That's right.
And that's a way to make a real killing on these products, which ordinarily are somewhat. I mean, the rule of thumb is that they produce about 2% more per year than bonds, right? But occasionally, if the option people get it wrong, or there's a sudden spike, you can make a lot of money. But that's not why you buy them. Okay,
Correct.
One other thing about that product, do people understand, and I mean, even do I understand, I'm not sure, exactly whether it's the question of renewal rates for these products, and that the companies can, for understandable reasons, protect themselves from interest rate risk by changing the rates. And are there any rules of thumb that, or any rules that you have on the platform for making sure that people don't get renewal rate surprises?
Yeah, so I mean that's been a criticism of some products in the past, and what we look at is a consistent renewal rate history. So on the products we're going to offer, we're going to show you from the carrier what their renewal rate history has been. Mm-hmm. and where there's really been issue in the industry is where call it carriers might pop a rate in the first year to make mm-hmm. it attractive from a sales point of view. In the RIA world, you really that's not a good thing to do, right? Because you're not selling a one-off product. You're trying to convince an RIA to use this as part of their core portfolio strategy. So what we do is, one, make sure carriers have consistent rates in terms of their renewals, and they do. And the reason they can offer consistent rates when they're not just trying to spike something in a different channel, like in a commission channel to generate sales, is because basically the way the product works is when they're investing in tranches. So the carrier might get 2 weeks of sales that come in, and then they're going to invest all those assets into a tranche of fixed income, right, in their balance sheet. So that tranche is going to then generate the benefit into those contracts. So year after year, because the carrier can hold those fixed income instruments to maturity, they're going to get a very predictable return. So the cap rates should be very consistent, mm-hmm. subject to option pricing, which is mm-hmm. less of a driver of the cap or the participation rate than the amount of interest being generated. Okay. So the only thing that really, the only variance is going to be difference in option pricing and lapse rates. So mm-hmm. So you're going to, if you're getting a good product, you should experience a very consistent return and cap cap participation rate mm-hmm. experience for your client.
Sure. Well, especially with this with the RIA product, the carriers know that they change the rates at their peril. Okay, let's move on to let's take this is one of my favorite areas, because this is where people get creative with annuities. There's a lot of things that they can do, obviously, and I listed some of them here that I think of, which is, and you mentioned that the guaranteed income in retirement, is that you're seeing a lot of interest there?
Absolutely, and mm-hmm. and this is great. I'd like to talk about this in terms of and great the way you set that up, because so many RIAs generally only think of annuities as SPIAs, mm-hmm. Because those are single premium immediate annuities. Those are the products they've used in the past, either that or investment only variable annuities, just to lower the cost of on an exchange. Mm-hmm. And so oftentimes you hear these misconceptions from RIAs about annuities. It's like, I don't like them because they're irrevocable decisions. You're annuitizing the assets. You can't, you lose flexibility and all that. And mm-hmm. the fact of the matter is, there are many different products with many different options. So understanding them is really important. And you're asking about guaranteed income. I mean, this is something that, RIAs can't solve for if you're using investment only strategies. There's no such thing as an investment product that provides guaranteed lifetime income.
Mm-hmm.
And guaranteed lifetime income, is something, that, academically, is shown to be, a very efficient means of generating retirement income. And typically, the proof point that we see and the aha moment, if you have RIAs who are, maybe haven't read Wade Pfau or David Blanchett or some of, the academics who write about these, is illustrating them in their financial planning software. So when you get an annuity and you put it in the financial planning software and you see the benefit, that it can bring to a client in terms of an increased Monte Carlo score, decreased shortfalls, income shortfalls, you often see that's what kind of brings the power of the product to life, for many advisors and their clients.
Mm-hmm. Mm-hmm. Now, when people are looking at the FIA with the guaranteed lifetime withdrawal benefit for retirement income, they generally have higher rates, according to the data that I've seen on Canex, than say a deferred income annuity. And part of the reason is because they calculate higher lapse rates in there. But to get the most out of those products, you need to commit to the 10-year deferral period. I mean, so you can't come into these. So if I'm an advisor, this came up with a person I know who was working with an advisor. She wanted to retire in 7 years, and the advisor said, well, we're going to get this product for you, and you have to wait 10 years in order for it to be fully fruitful for you. And she said, well, I want to retire in 7 years.
Right.
So how does this get finessed into if you don't happen to catch someone who's 10 years away from needing income? I just wonder how advisors deal with that. Maybe that's something you've talked about.
Yeah. I mean, I wouldn't agree that that's like a general product rule of thumb, or a category rule of thumb. I mean, that might have been for the specific product that advisor was talking about. But products are structured in different ways. So we've got products from Allianz, Jackson, Midland, maybe a couple others, where you get those deferral credits I think you're referring to. And so which means that, okay, if your client is 55 years old and they want to take income at 65, if you took income today at 55, you'd get paid out at whatever rate, say 5%. And then the deferral credit, the way it works is each year you delay, kind of similar to Social Security, you get a better payout if you delay taking it. You might get an additional 25 basis points, 35 basis points on top of that 5%. So the longer you wait, the higher your payout is. So I don't know, where 10% might be optimized. But so that's one way that some of those riders work. Other ways is, we've got, a great product from Security Benefit, where there's an increasing income amount, and it doesn't as much matter, about the, having a waiting period. The power of the product is the fact that the income increases 2% every year. So you've got, you're helping to retain purchasing power. So there are many different products, for different people and different needs and time periods. So, I wouldn't, put rules of thumb that 10 years is the right time, but we generally recommend to the firms we work with, you start considering, an FIA 5 to 10 years, outside of retirement, because you're going to have the most options. You're going to have the most product options you can start thinking about. And plus that's the time where your client is getting into sequence of return risk, particularly that 5 years before and after retirement. So a safe product like an FIA that has downside protection and can generate income without having to hit a portfolio, it makes it a really good sequence of returns mitigator.
Well, the insurance products for me have always been the ultimate. They're the parasol in the sunshine and the umbrella when it's raining, and their beauty is that you either way you're covered. Now,
right.
It's interesting. I wonder if advisors are still encountering the no annuities reaction, though, from clients, and how they fit that into this framework, or vice versa? I mean, one way is to create, you know, an overall product allocation strategy and to present the annuity not by itself, but as part of a total plan. But let's go back to that idea of, you know, people are going to say, well, no, I heard that annuities are bad. What do advisors say? How do they
Yeah,
finesse?
we actually see it a lot with our members, you know, going in both ways. You know, we work with, you know, about 1,000 RIA firms now, and we see it working both ways, where you have the advisor who's a little worried, and when they talk to the client about it, they're taken back by how excited their client is, because their client is looking for safety and security, you know, in their retirement. And sometimes you get that, and then other times you get, you know, the advisor who's a little, you know, who's not sure how the client's going to react to the A word, you know, as David Blanchett, you know, from Morningstar will talk about a lot. So what we've, you know, we have you know, a lot of educational materials, you know, on our site. We did an event the other day with a couple of our advisors who talked about just this problem, you know, and how do you talk to your clients about it? And what they both said is they really talk to their clients, starting to talk about the benefits. You know, here's what we're going to do. We're going to look to a product that's going to help generate lifetime income. We're going to meet your essential spending needs with that. So those are guaranteed, and you can be secure about that. And when you start talking about the benefits of the product, you know, people don't object to the benefits of annuities. Guaranteed lifetime income. People love guaranteed lifetime income. You know, it's the A word, you know, might, because they may have read things and they're not sure why they should dislike them. Oftentimes they're just you know, they think it's something they should be wary of. But when you talk about the benefits rather than the name, it's something that, you know, that people like. You know, would you like to fund a personal pension? Yes, I would. You know, I like the idea of having the security of guaranteed income.
Sure. Okay. Well, let's now look at the platform. This is what can advisors expect? There's two parts of this that I think are, let's talk about the money. There's the money to the advisor from the product, and then there's the money from to the advisor from the product, and then or the account, and then there's a cost to advisor for using the platform. So let's follow the money a little bit here, and then maybe we can talk about the technology and the carriers. But what about the billing first? That's always top of mind.
Yeah. So in starting DPL, you know, the first notion was, if we're going to, you know, solve insurance problems for RIAs and give them these tools, first we have to have products, right? And the first thing with the products is they've got to be commission free. The second thing is that they've got to enable billing, so that, you know, the advisor can charge their AUM fee. Ideally, they can take it out of the product if they choose to. So the carrier needs to support that. And enable you know, the advisor to bill from the product, or at least, you know, get a download into their technology desktop, into their portfolio management system, so they can bill on the annuity asset just like they bill on any other asset. And so that's what we see a lot, right? So the advisors, you know, who use the platform, annuities are now not a financial disincentive. You know, some advisors used to call them annuicide. You know, using annuities, you're killing your own company's revenue. So it's now, you know, now they're not only, you know, not a conflict of interest from a revenue point of view, they're revenue positive. I mean, you can bill on the products. You can do it, again, directly through most products, and most carriers support that today, or you can do it, you know, by aggregating, you know, the account balances into your portfolio management system and bill from centrally. So that we see both of those things. And then, you know, the second part of, you know, building, you know, the DPL platform is getting advisors engaged, and, you know, we do that through a membership model. So since the notion being, you know, effectively RIAs are novice users of annuities, you know, so we've got to educate them on how and when and why you think about annuities, what products are available to you, and how you should think about them. And it's great to hear it from us, but it's also great to hear it from other people. So we created this membership network. So, the RIAs who join can have access to the academics that we bring that we bring to the table. They can have access to each other, and hear about how other firms are using and billing on products, what product strategies they like, and we create this community. And in addition, the power of that network, gives us power with the carriers, that, hey, we've got 1,000 RIA firms, that we're working with. Here are the kinds of products they want. Here's the kind of, pricing, we're going to need for them. So that's so that's kind of the power of the network. And so those 1,000 firms, depending on their AUM, they pay us, $1,000 to $5,000 a year to be a member of the DPL platform. That gives them access to our, our technology, to our insurance consultants, and to each other.
As far as education and support goes, is that mainly material online, or is there any actual phone mediated handholding that goes on?
There's both, yes, and we absolutely. So we've got plenty of materials online. We've got all kinds in whatever format you want to digest material, whether you want blogs and webinars, or you want videos, you want white papers, you want articles. We've basically got it all. Relative to general concepts, specific products, how do you, operational issues. I mean, we've got just loads of content, for advisors, to digest. And then of course we've got support through our, our group of, consultants, who, number about, 25, today, to support our firms. And they're there to help with the with the product selection process. They're going to act as the agent of record, and they're basically going to act. DPL is effectively going to act as your insurance department, for an RIA. So we're a completely turnkey platform that literally, you can know nothing about insurance other than your client's need for it today. You can sign up with DPL and tomorrow be have full service insurance capabilities.
Now, how much, when they integrate with the platform, does it involve? Is it an icon on their? Is it part of their existing? Can it adapt to their existing software and their planning material, or is it, or does it require like an all-in?
So we're working. So our technology, we've got, we've built, a lot of what we call product discovery tools. So which enable you to do comparisons of products, based on your client's needs and their age, and let's help find, the products that will best suit those needs. And we're working, constantly on technology integrations, and we're going to be announcing a couple of big ones here, literally within the next week. Where those tools will be integrated into advisors' desktops, but they're designed often to work in conjunction with either your portfolio management system, where you're constructing portfolios, or your financial planning system. If you're looking to solve for an income need, for example, for a client, you're looking to solve for $5,000 of monthly income. We can help you find the product that will most efficiently do that. But yeah, a lot of it, so a lot of it today is, built by us, will, eventually become more and more, integrated into their desktop. That's the ultimate goal.
Well, big picture, this capability, I think, is tremendously important for the differentiation of a competitive differentiation for the advisors, and I think it couldn't be a more important an issue for. I've always believed in what I call the ambidextrous advisor, and who can deal with and which is, I think of as risk off, and investments as risk on, and that you can, when you and then you have a certain risk budget that people have. If you reduce risk in one area by using insurance products, you open up opportunities for risk taking in other areas. And and to me, insurance it's an opportunity creator. The conversation gets a little confounded when you it's very easy for this to happen, is to have the insurance conversation talk about yield and internal rate of return. When I think about insurance, it's what does the insurance let me do? You know, the car insurance lets me own a car and take trips and not worry about it. Having AAA or whatever enables me to. It's the opportunity side that is where, and I think there's an opportunity for advisors to get a light bulb going off over clients' heads by telling them, you know, now you have the freedom to do this other thing. What is it you want to do that insurance is and stability and guarantees are going to allow you to do? And
exactly.
And that's the most because otherwise you get bogged down into looking at insurance as a cost, or trying to look at or to compare them to investments, and they tend, in that frame, they tend to look like suboptimal. Okay, so now is a good time to turn to Q&A. We left some. We've got about 15 minutes here because we wanted to handle as many questions as we had time for, and we do have quite a few. Let's see. Please address the acquisition of annuities as an alternative to fixed income securities, because it generally results in conversion of taxable assets to tax deferred status. So we have and we're talking about the acquisition of non-qualified contracts.
Yes.
Taxes aren't my strong area, but maybe you can address this.
Yes, I'm not going to pretend to be a tax expert either, but I have written a white paper on the use, the tax efficient frontier, and utilizing tax deferral within annuities, mostly focused on the variable side, but it's of course you need to consider, because you're moving to a retirement account, liquidity. I mean, that's the big concern. Otherwise, the tax deferral aspect is great. I mean, particularly, as opposed to fixed income, where you're already getting taxed at ordinary income rates, in fixed income. So the tax deferral provided by an annuity is particularly efficient, for fixed income assets, because, that's, oftentimes, clients or advisors worry about, the taxation, of the income when it comes out of the annuity being taxed at ordinary income rates. Well, when you're exchanging it for fixed income, which is already getting taxed at ordinary income rates, you've got the benefit of better accumulation, because that interest isn't being taxed, until it's taken out of the account. So generally, it's a much more efficient thing to do, but you are making that liquidity trade-off. So you need to be wary of that.
Another question is there any way to pull fees from the products directly, or must they be taken from outside accounts? How exactly does that work?
So what happens is kind of similar to the paradigm that RIAs are used to, is the custodial one, where the customer really owns the assets, which are being custodied at say Schwab or TD or I guess they're going to be one and the same here shortly, Fidelity. And those assets are being custodied. Then the advisor is added, through a limited power of attorney, to have discretion over those assets. Basically, the model with the insurance carrier is the same. So, the product gets opened up. We act as agent of record in our case. The advisor is put on as the advisor of record, just like through a limited power of attorney, which gives them the ability to pull fees from the product. Now, most carriers support that directly, and I would tell you some are better than others. Some are going to give you basically a lot of flexibility in how you do that. They'll have automated payments that'll just come out quarter after quarter that you can set up. And others support it, but they're a little clunkier. But that's kind of a work in progress, so to speak. But most carriers and most products will support you billing your fee directly out of the product.
Okay. We have a question from Anonymous, the same person who wrote the collected works of Shakespeare, by the way. Does the membership model also help in solving licensing challenges that RIAs may have?
Yes, it does. Our business model in general. So helps do that. So, I'd spent 10 years as the COO of Jefferson National prior to founding DPL, and there kind of developed the model of having like an internal desk, insurance desk, which served as the licensed agent for the RIA. They may not have understood, a lot of RIAs may not have understood that that was what's happening, but we do that very explicitly. So we serve as the licensed agent. We're ultimately making the specific product recommendations. Financial advisors, whether you're licensed or not, are generally given the ability to provide general financial advice, general insurance advice. Where if you're not licensed, what you don't want to do is make a specific product recommendation. I think you should buy this product to my client. That's kind of selling a product. You need to be licensed for that. What you can say is you have the need for guaranteed income, or I would recommend you get an annuity for guaranteed income. My insurance partner, like in our case DPL, after I told them about your plan and your situation, they've presented this product as the best option. Mm-hmm. So that's how the membership and our model helps solve for that.
Okay, we have quite a few questions here from someone who believes that we're running a promotion instead of an objective education session. Okay. And I'm sorry, but I mean, we can, maybe next week we'll have a webinar on trashing everything that we're talking about today. But we're playing favorites for this half hour and taking a look at this subject. I hope we haven't been too Pollyannish about the products. I mean, my feeling is that in answer to this questioner is that you really should look before you leap into index annuities. I would read closely Retirement Income Journal to find out exactly how they work and to make these decisions as carefully as possible. This is not a simple, easy. There's a lot of money at stake here, and we take it seriously. And I hope that this is not, that we're getting at some of the issues. Let's move on though. We have more questions about how the advisory fees are deducted. I think we've covered that. We have a question from asking what are some good resources to use for guidance on tax issues, such as the deductibility of premium costs. Deductibility of premium costs, that's kind of a new one on me. Does that sound familiar to you?
Deductibility for annuities, yeah, surely that would be a new one on me. And maybe that there are some specific. I would go to a typical CPA or estate planner that you might work with, for those kind of questions.
Okay. So if fees come out of the product, what are the tax implications exactly?
So within non-qualified annuities for a long time, that was an issue for advisors, because in qualified plans you were able to deduct your fee and take your fee without tax implications to the client. And in non-qualified, that wasn't the case. It was a taxable event. Your client would get a 1099, and that was an objection and problematic. A little over a year ago, I believe, a number of carriers applied for and received a private letter ruling from the IRS, basically giving permission for those fees now to come out in non-qualified products on a without creating a taxable event. So that's been a really positive development in the fee billing and support of an advisor's fee billing model. When prior, if you were going to be getting a commission wasn't taxable, right? So, but now this kind of levels the playing field through that PLR, and most carriers have now, who are working in the RIA space, have applied for and received that PLR.
Now, we have a question about, I'm not sure whether we covered this or not. How about internal costs and surrender charges? What role do those play in the products that are being built out? I wonder if he means behind the scenes, how those charges are. Now, surrender charges are, there are surrender, let's talk about surrender charges for a moment.
Okay.
There are surrender, even though some of these products do not have surrender charges, correct? And some of them do, because you have a breakage kind of a problem if you don't have a surrender charge. So could you illuminate that a little bit?
Yeah, so surrender charges are another one of those annuity aspects that that a lot of advisors don't like. They view them as being there to help recoup commissions. And that is true within commission product world, but in our world, what surrender charges are there for is for duration, right? So like just like anything else, when you invest in something with duration, there's potential penalty for effectively early withdrawal or trading out. What we like to see within products, and we've got a number of products that are in the realm of fixed index, in particular, where there aren't surrender charges and there's more what they call market value adjustment. We like those products. We like that better than the surrender charge, because the surrender is a defined penalty effectively for early withdrawal, which is understandable. Because you're breaking the duration
Sure.
that the carrier's invested on. But the market value adjustment, what that will do is effectively work more like a bond. The bond may, if you sell a 7-year bond early, it may be in the money, it may be out of the money, depending on which way rates have gone. So that's the way we prefer to see the duration protection within products, is through market value adjustment. But surrenders aren't necessarily bad things, right? You have to understand, again, you are giving up liquidity when you have a product with surrender, but it's to get more benefit, right? So when you look at products that have surrender fees, it's so the carrier can be more confident in the duration of the asset, and they can invest longer, they can provide better benefits within the product.
We have another question. Other than billing, what are other key operational challenges that you have come across for fee-based annuities?
Yeah, the biggest thing is that you want to be able to get it into your portfolio management system. So you can, as an advisor, you can see it as part of the rest of the portfolio. You can see it, as an asset alongside the brokerage account or the investment portfolio. So you get a complete financial picture. And you can understand, even better, you can understand the role the annuity is playing within that portfolio. So, that's the biggest operational challenge. In many ways, for years, talk about, using a low cost, variable annuity, for tax deferred accumulation. It makes great sense. Put, tax inefficient assets into a low cost variable annuity. And it makes all kinds of academic sense to do it. And you're going to improve returns to your client by doing it. But the operational aspects are a little challenging. How do you rebalance across an annuity to the equity portfolio? So that's the biggest challenge. But again, today you can get more and more. You can get all the data from your annuity downloaded and integrated into your portfolio management system. More and more financial planning software support modeling annuities within the financial plan. So where technology was 5 years ago was that it was really challenging to use annuities. And today, what we say, the technology is sufficient and getting better all the time.
Okay. We have a question. Does the addition of annuities to an RIA's practice involve new due diligence on part of advisor? Also, are variable annuities represented on the platform? The fee-based movement is beginning there as well, or if they are not, are they thought of differently? You do have the variable annuities, right? We kind of gave them short shrift.
Yeah, so we've got, if you look at again, part of what we're trying to drive at DPL is just the creation and availability of products. Right. So if you look just 5 years ago, again, you had just a couple of carriers offering a couple of different products, to the RIA market, and they were really, investment only variable annuities. So even when people thought of variable annuities, they weren't the traditional variable annuities with riders and guarantees and other features. They're really stripped down versions and I think that was because that's what we did at Jefferson National, and we had a lot of success doing it. A lot of carriers kind of tried to imitate that by saying, okay, we'll launch similar products. But what really needed to happen was, full featured products needed to be available on a commission-free basis. And that's what we've tried to drive at DPL. So today we've got 20 different carriers on our platform with, 45, 46 different products, all kinds of annuities, SPIAs, DIAs, fixed products, fixed index products, variable products, buffered annuities, RILAs, those types of products, life insurance, term and permanent. We just launched the first ever commission-free disability product, a couple of weeks ago with Principal, and we've got a hybrid annuity product designed to address long-term care issues.
Okay, I think we've just about run out of time. We're going to have for those who are interested, we're going to be able to make not only the slides from this show, these slides are conversational slides, but also a more robust package of slides that goes into more detail that David's folks can provide, and we'll have a link to those. I just want to thank David very much for coming on. I'm a big admirer of first of all, he's done a lot of heavy lifting as an entrepreneur to make annuities more accessible. He was with he built a platform. He helped build a platform for bringing variable annuities for various purposes to RIAs, and proved that there was a market here. And he established, took close ties with them. He's just he always returns my emails when I have questions for him, and this really endears people to me because I can get a straightforward answer, and that's one of the reasons I wanted to share his views with you today, because he's a stand-up guy, and he tells it to me straight when I ask him a question, which is great. So
I appreciate it, Kerry. It's I'm a huge believer in the fiduciary model. I'm a huge supporter. I've dedicated much of my career to supporting it, and we think this is a through DPL, we think this is a big step forward in helping deliver more capabilities, more tools to the fee-based fiduciary advisor to help better serve their clients.
Okay, well, we all have a lot of work to do, and now we can do it better, I hope. Okay, thanks everyone for joining, and look for, I'm trying to think of where those slides will be available. We will be able to send a link to everyone who's signed up for the show. Okay, thank you for joining us, and until next time, I'm Kerry Pechter at Retirement Income Journal.